Hi, welcome to Sihina Publications, and this is cash flow third question, Senesh PLC in English medium. So first of all, these are my two books, company accounts and cash flow statements. So each book have 25 questions with answer books, and also I will uploading and I'm still uploading. Yes, I'm uploading all the explanation videos for all those 50 questions. Right? Okay, let's move to the question. Yes, so here this question is given the income statement and the SOFP, and the main thing is this company started their operations on 1st of April 2023. So which means as at opening date, they started this business. So from that you have to get the idea there is no any opening balances because this starts new in this opening date, right? So first adjustment, all sales and purchases done on credit basis. So you can find so all done on credit basis mean there is no any cash sales and cash purchases. That's the first thing that you have to get the idea. There is no any cash purchases and cash sales, and there is only credit sales and credit purchases, right? So with the with the credit sales, when the credit sales happens, the debtors are incurring. So the cash flow that relate to the debtors is debtor receipts. So you have to find out debtor receipts from debtor control account. So trade receivables, debtors, same terms, and total sales 14,000. You have to extract that from the income statement, and the balance carried down as a closing date is given from at the SOFP, and then 14,000 total sales and the closing balance of debtors. So that's mean debtors are still payable for us 3,400. So from that you can find out you received 10,600 from your debtors. So that is a cash flow that you are recording operating activities debtor receipts. Same thing for trade payables. But first of all, you have to find out purchases because in the income statement, sales you can extract it directly, but purchases you can't extract directly because these purchases is including in your cost of sales. So income statement is given only cost of sales next. So you have to find out the purchases that including in cost of sales, right? How to find out cost of sales? Opening stock plus purchases minus closing stocks, then you are getting the cost of sales. So this 8,000 cost of sales is extracted from the income statement, and the closing stock extracted from the SOFP, statement of financial position. So which means your purchases are 9,000. So 8,000 plus 1,000. You have to go backward from the equation to find out purchases. So 8,000 plus 1,000, your purchases are 9,000. So now you know the purchases, and these all purchases you done on credit basis, and creditors there is still payable as a closing date 2,450. So which mean within the year the company paid for creditors 6,550. It's a credit payments, and you have to record that in operating activities as cash outflow. That is your first adjustment. Second one, it says finance expenses include bank charges and bank loan interest both. Uh, so from the information, first of all, that bank loan 4,000 that appeared in the SOFP, you have to record that as cash inflows in finance activity. So there is no any opening balances. So which mean you obtain this loan within the year. So you obtain this loan 4,000 as at opening day. It's given the information in SOFP. So the 4,000 bank loan obtaining, you have to record in financing activities, right? So 4,000, and it says the annual interest is 10%, and this loan you obtain on 1st of April. So which means as at opening date. So 4,000 into 10%, your interest that will earn for the year is 400. So whether you paid in cash or not, that 400 interest you are recording in your finance expenses. So here the total finance expense is 500, and this 500 include your loan interest 400. So which means the bank charges that you that expense for the year is 100, and there is no any payables for bank charges. So which means these 100 bank charges that for the year you paid already in cash. So these bank charges you have to record in operating activities. And the interest for the year is 400, and in the SOFP it says the interest payable as a closing date is 150. So the total interest 400 and is still payable as a closing date 150. So which means you paid the interest for this year in cash 250. And there is a specific place in operating activities that you have to record the interest payment in operating activities after the cash flow that generated from the operating activities. To convert that to the net, you have to deduct interest payment and tax payment, right? That is a specific place that you have to record the interest expense that you paid in cash within the year. Third adjustment, it says components of proper plant and equipment as at closing date. And these all proper plant and equipment you purchase within this year because there is no any opening balances, so which means this machine, buildings, and motor vehicles, all these proper plant and equipment you purchase this year, so that you have to recording investing activities as a PPE purchases. It's a cash outflow. This total 17,500, and it says accumulated depreciation on that flow. So the total accumulated. Normally, the accumulated depreciation mean the total of the accumulated depreciation from purchasing date to up to that date. But in this case, there is no opening balances. So this company started on opening date in this year. So this accumulated depreciation refer as depreciation for this year as well, because there is no any opening balances. So these closing balances, these are the depreciation that happened for this year as well, right? So machine was depreciated 1,500, buildings was depreciated 600, and motor vehicles 400, right? And from these informations, the depreciation is not a cash transaction. It's not a cash outflow. It's an expense, that's correct, but it's not a cash flow, right? So normally you are recording this machine depreciation, building depreciation in administration expenses. So from the administration expenses, actually you have to deduct these depreciations, because depreciation is not a cash expense, cash outflow, but this is an expense, so you record that in administration expenses, right? So administration expenses, that the total admin expenses that appeared in the income statement is 3,250. From that, you have to minus the depreciation of both buildings and office equipment, right? And there is another adjustment that you have to do for the administrative expenses. The SOFP, in the SOFP, it says it's appeared the admin expenses payables in current liabilities. So admin expenses payable is balance brought forward in credit side is a liability. So which means balance carried down in debit side. So from adjusting those transactions, you can find out what is the actual amount that you paid for admin expenses in cash, right? The total admin expenses appeared in the trial balance 3,250. From that, depreciations are not cash flow, so you have to deduct that. And also there is still payable 325. You have to also deduct that to find out what is the actual amount that you paid for admin in cash. So that is 825. In distribution expenses, same thing. In distribution expenses includes motor vehicle depreciation, and motor vehicle depreciation is not a cash transaction. And in SOFP, it appeared distribution expenses paid in advance. It's an asset. So balance brought forward in debit side and balance carried down in credit side. So from adjusting those informations, you can find out what is the actual amount that you paid in cash. So you paid 1,255 for distribution expenses. So both administration expenses payments and distribution expenses payments, you are to record under operating activities as cash outflows. May let me know if I'm speedier. Okay, I just want to cover this from 15 to 20 minutes, so that's why I'm product speedy. But if it is uh, not getting good, so let me know. Please do comments. Any compliments or any complaints or anything, please do comments, because your comments motivate me, and I know that you are watching my videos and doing exercises through your comments, right? Fourth one, other income represents investment income, and there is no any liability or assets in SOFP. So which means what can be an asset for the investment income? It can be investment income receivables, and the liability income is investment income received in advance. So in the SOFP, given SOFP, it's not appeared either of that. So which means the total investment income for the year is already received in cash for you, right? And the total other income you have to record as investment income in investing activities. The company paid dividends for the year. These are the interim dividend payment, and you are paying dividends for your shareholders through retained earnings. First of all, the profit that you are generating from the income statement, you are transferring to the retained earning account. That is 1,000, and this comes from the income statement. And from that 1,000, the closing balance of retained earnings is 750, and that appeared in the SOFP. So, which means you paid for your shareholders as dividends 250. So, dividend payment you have to record in finance activities as cash outflow. So that's it for actually for the direct method. And let's see how this question that can uh, do in indirect method. So operating activities is the only activity that uh, difference as direct and indirect, right? For investing and finance, it's same thing because we can prepare the cash inflows and outflows, cash flows for investing and finance only based on direct method, right? But operating activities you can prepare in both ways, right? So this is operating activities that you made on the indirect method. So in indirect method, when you are finding the operating activities, the base that you have to use is profit before tax. So the profit before tax that appear from the income statement, structure from the income statement is 1,350, and this 1,350 you have to do the adjustments. And here we are adjusting non-cash expenses or incomes that we recorded when you are finding the profit, and the transactions that not relevant for your operating activities, right? So first thing, interest expense. So why you are adding interest expense as in adjustments? Because uh, from here there is a specific place to deduct the interest payment that you made in cash. So here 250 is the interest expense that you made in cash, but the interest expense that relevant to the year is already deducted when you are finding the profit, right? So and again you are deducting here interest expense now. So to avoid the double deductions, you are adding interest expense here. It's a reverse transactions, right? You are adding interest expense here, and here you are adding the interest expense that relevant to the year. And at the down, you are deducting payment that you made in cash. So that's the difference. Huh? You are in adjustments, you are only you should add the interest expense that relevant to the year that you recorded in your income statement. But here you are deducting the interest that you actually paid in cash. And property plant and equipment depreciation. So depreciation is an expense, but it's a non-cash expense. So when you are finding the profit, this you treat it as an expense and it's already deducted. And to reverse that entry, you are adding here property plant and equipment depreciation. And investment income. So investment income you normally should record in investing activities. But the investment income, so the incomes that you are generating from your investment decisions, those are already included in profit before tax under other incomes. But when you are preparing the cash flows, you have to record those investment activities incomes in investing activities, right? So this investment income 500 is already included in profit before tax, but you have to record this in investing activities. So to reverse that, you are subtracting investment income from here, right? Then you are getting the operating profit before working capital changes, and then you have to do the working capital changes. So here all are increasements because there is no any opening balances, only closing balances. So which mean all the non-current and current assets and current liabilities are increased throughout the year, right? The closing balance, the difference, not actually the difference because there is no difference, there is no opening balances. So the whole closing balances you have to record here. And when the current assets increase, we treated that as cash outflow. And when the current liabilities increase, we treated that as cash inflow. So that's what I did here, right? And then that's it. So either in direct method, indirect method, if you recorded those two in correct way, so the answer should be same. Huh? So then you can find out that you did that correct or not. So that's it for this question actually. This is a bit simple question. It's given the income statement and SFP, and it's given the adjustments, and from those adjustments you can prepare this cash flow either direct method or indirect method, right? Okay, so let's meet with other questions as well. Keep in touch. Thank you. And if you want to purchase my books, please drop me a message through WhatsApp so I can deliver in any place in Sri Lanka because I am partnering with Kubio Deliveries, right? Okay, thank you.